Hey everyone, and welcome back to the channel. What if I told you the US government is doing something it's never done before to get its hands on a staggering amount of cash? This week, our government is making history by selling a record $100 billion in short-term bonds that pay you back in just 4 weeks. That's right, $100 billion in a single go. This isn't just a new high for these specific 4-week bonds, it's a new record for any single bond auction ever for any term. This unprecedented move is a huge deal, and it's putting a spotlight on some big questions about our nation's finances and how they impact your wallet. So, why is this happening, and why now? Well, the government needs a lot of money, and quickly. They're trying to refill their cash reserves after the government's borrowing limit was lifted in early July. But it's also about plugging a massive hole. Our federal budget is running a huge deficit. We're talking about an estimated $4 trillion deficit expansion from policies put into place by previous administrations. But here's the interesting part. Instead of borrowing money for longer periods, like 10 or 30 years, they're really pushing these super short-term bonds. Why? Because the Treasury Secretary said in June that the returns on those longer-term bonds are just too high right now. It's cheaper to borrow money for a few weeks than for many years. And get this isn't a one-off. Experts are saying this is just the beginning, and we should expect to see even more of these short-term bond sales in the coming quarters and years. The Treasury expects to raise auction sizes again in October. Just to give you a sense of scale, this $100 billion 4-week bond sale is equivalent to more than a quarter of all the bonds the United Kingdom sold in its entire fiscal year. This week alone, besides the $100 billion in 4-week bonds, the government is also selling another $125 billion in longer-term bonds. Now, who's buying all these short-term bonds? Mostly, it's big pools of cash from investors, known as money market funds. They currently hold over $7 trillion in assets. So there's a lot of demand for these quick-pay government bonds, at least for now. These funds prioritize being able to get their money back quickly and safely, making them reliable buyers. But here's the catch. Relying too much on this quick cash comes with some serious risks for the government and, by extension, for all of us. First, while this strategy helps avoid pushing up long-term bond returns right now, it means rapid turnover of debt. Every time these short-term bonds mature, which happens frequently, the government has to borrow that money again at whatever the current interest rate is. If interest rates go up, it means higher borrowing costs for the government, and that could really add to our nation's debt burden. It's like constantly refinancing a home loan, hoping rates don't skyrocket. This is what experts call refunding risk if the conditions for borrowing get worse. Second, while short-term government bonds currently make up about 20% of our nation's total debt outstanding, that number is projected to climb to between 23 and 25% by 2026. This is actually above the average level, around 20%, that an outside panel, the Treasury Borrowing Advisory Committee, recommended should be maintained over the long term. A growing reliance on quick cash could lead to more instability if market conditions change. And what about the Federal Reserve? They've been keeping short-term interest rates relatively high, currently around 4.25 to 4.5%, which has made these short-term government bonds attractive. But here's something crucial to watch. The Fed is widely expected to start cutting interest rates as early as September. When people think rates are going down, these big money market funds tend to tie up their money for longer periods to lock in higher returns, which means they might not be as eager to buy these super short-term bonds if they can get a better return on something that pays them back in, say, 2 months instead of 4 weeks. In fact, these funds are already holding on to money for about 40 days on average since May, which is near a record high. Some strategists believe this limits their capacity to absorb even more short-term bonds that mature in more than about a month and a half. This also highlights a potential disconnect between the Treasury's need for cheap financing and the Fed's goal of maintaining stable prices. So, what does all this mean for your money and the future of our economy? First, stay alert. If you're an investor, you need to pay close attention to what the government is doing with its borrowing and what the Federal Reserve is doing with interest rates. The long-term stability of our financial system hinges on both the government's ability to keep borrowing and the Fed's ability to manage its policies and their unintended consequences. Second, consider your investments. If you're holding a lot of short-term investments, you might face the risk of having to put your money somewhere else at a lower return if rates drop significantly. Some experts suggest looking at bonds that protect your money from rising prices, or those that pay you back in the middle term, like a few years, to hedge against these fiscal and monetary imbalances. Given the current situation where short-term bonds offer attractive yields, prioritizing portfolios that hold short-duration bonds is a good strategy. Third, watch the signals. The returns on 4-week bonds are currently almost the same as on 10-year government bonds, around 4.3% for 4-week T-bills versus 4.2% for 10-year bonds. This is highly unusual and suggests that the market expects slower economic growth and potential rate cuts from the Fed. You should also keep an eye on how well these bond auctions are doing, often measured by something called the bid-to-cover ratio. While the exact numbers aren't always public, a low ratio could signal weaker demand and higher future borrowing costs for the government. Finally, think globally. While American investors are currently buying up these bonds, international demand for U.S. government debt could slow down if global growth weakens or if other safe investment options become more appealing. This could make bond returns even more volatile down the road. It's a complex balancing act, and our government is taking some big, unprecedented steps. We'll have to keep a close eye on how this record borrowing impacts everything, from interest rates to the overall economy. This fiscal experiment of relying heavily on short-term debt in a high-debt, slow-growth environment is still unfolding, and its long-term sustainability is definitely something to watch. What do you think about the government's unprecedented move? Let me know in the comments below. If you found this information helpful, please give this video a like, subscribe to the channel for more financial insights, and don't forget to hit that bell icon so you never miss an update. Thanks for watching, and I'll see you in the next one.